Hello there, I'm Hannah Wise. Welcome along. Switzerland's businesses are not ready for the coronavirus. That's the verdict from a crisis management firm who have been surprised by the lack of action to prepare for the spread of the virus. Olivia Chang has been looking at some of Switzerland's top firms to find out what they've been doing to get ready for an outbreak here.
Swiss companies are gearing up after Switzerland's first case of coronavirus. The Federal Office of Public Health describes the risk as, quote, moderate. But many businesses are not taking any chances. Food giant Nestlé in Vevey has suspended all business trips worldwide until March 15, a spokesperson has confirmed. Migros Group, Switzerland's largest food retailer and private employer, has also created a crisis team to deal with potential disruptions to supply. We are working on solutions for expected problems in global logistics. Meanwhile, Swiss Life has also conducted stress tests for severe pandemic scenarios for many years and has launched a task force. But experts warn about the readiness of Swiss companies.
I think that Switzerland, in terms of healthcare, is well prepared. But in terms of if there's a contagion and it goes very rapidly, I'm not sure if we can be very well prepared. For enterprises that are not used to this kind of preparedness, I think they're not simply ready for that.
CNN Money Switzerland reached out to the country's largest firms, and many have put restrictions on business travel. Manufacturing and engineering firm ABB has restricted travels to South Korea unless it's, quote, business essential, and has also banned travels to and from the Italian regions of Lombardy and Veneto. Other employees are being asked to work from home for a fortnight if they have travelled to affected areas, and many have been urged to move toward video conferences and phone meetings. The Swiss government has rolled out information campaigns at the border and stepped up its testing of those with flu-like symptoms. Until the further developments, it's business, just not quite as usual. Olivia Chang, CNN Money Switzerland.
Well, the shock from the coronavirus is rocking global markets for a fifth consecutive trading session. European markets were lower Wednesday as corporate profit warnings added to fears about the economic impact of the outbreak. Many companies in Europe reported that they expect to take a sales hit in the first quarter of 2020, while other businesses are struggling to assess the true damage. Oil prices also tumbled again Wednesday, and many are flocking to safe havens. Here to break it all down for us is Thomas Wieler, who is Head of Research and Strategy at LGT. Welcome back to the programme.
Thank you.
Markets have been really rocked in the last few days, certainly since it was announced that coronavirus is here in Europe. Is it all down to coronavirus?
Well, it really depends, because let's face it, it was in China, the coronavirus, it was far away from Europe and also from the US, and people just compared everything to what happened to SARS. So a lot of people made a lot of analysis, and the market was, from my point of view, extremely complacent. We have just seen 10 days ago, Apple made actually a top-line growth warning, and the market said, okay, let's shave it down 1 or 2%, but it wasn't really like the 5 or 10% hit that everybody was expecting.
And you think that that's what's happening now?
No, what's happening now, we are right now in the wave number 2, which means wave number 1 was just China. It's in that region there, and we don't see actually a widespread. And now it's coming into Italy, it's coming into Europe, and people have not second thoughts about, okay, what's happening actually in Europe now, and not also what will be then wave number 3. And that's why market really, I think they were completely on the wrong foot after more or less, we had some issues in January, but then beginning of February, we just went going back into the all-time highs. And markets, I think, were just on the wrong foot, which means a lot of investors are really wrongly positioned.
Would you say that this was a black swan event then?
No, not at all. I think a black swan event would definitely look different, and then we would be not down like 5, 6 or 7%. But
markets were complacent. I mean, maybe they should have had a little more foresight.
But a black swan event, from my point of view, would have a much bigger scale on the downside on equities than we talk about 15, 20 or even 25%. And we are not there yet.
So how hard is it for investors to navigate right now?
Well, it is actually a kind of a bipolar environment, because if in 2 months' time the coronavirus is already behind us, this is a clear buying the dip opportunity. But right now, there are still a lot of uncertainties around that virus. How is it actually going from one person to the other person? Are only the older people infected? Now we're getting more and more information also out of China. So it is when we are sitting here again in June and July, and we are still talking about the coronavirus, we are really we are then actually in the wave 3, which would be kind of crucial for the markets.
All right. Well, where do people put their money now? Is it in the safe havens, the Swiss franc, gold?
Well, actually, the market was actually playing 3 kind of asset classes. It was the US Treasury, hit an almost all-time low yesterday with 1.31% on one side. Then definitely gold. Gold was rocketing from 1480 up to almost 1680 within 2 to 2.5 months. And of course, the US dollar and the Swissy. But what is kind of interesting to see right now, even we took a massive hit yesterday on the US equity market, gold was not actually rallying towards the 17 or even 70.50. I would say now we are away from the complacency side. People start to realize, okay, how severe are the impacts? There will be definitely an impact for Q1 and Q2 GDP growth. There will also be an impact for top line and also for bottom line for all the companies. But if it's just limited on those 2 months, on those 2 quarters, the market will actually look through that. And then we will have a better second half of 2020.
What are you expecting then from the central banks coming up in March? The ECB will be speaking around the 12th of March, I believe.
I think the ECB as well as the Fed will be very cautious what they say. They will, if they have to do something, they go to the dovish side. The market is slowly but surely pricing in another, yes, you hear it correctly, cut by the ECB. We are now already at 2 cuts from the Fed. The market is pricing in with a probability of over 90% that the Fed will cut the rates in June. So what we are seeing right now, the market says is that coronavirus escalating means more stimulus from the central banks.
I was interested to read some analysts suggesting that given the situation now, we have the coronavirus here in Switzerland, that maybe the Swiss franc won't be so much of a haven, and actually it's the euro that will become the haven because, there's so many more countries involved there.
Well, right now, we are still in the phase of analyzing everything. And I would be really careful to say, okay, we are going to do one or to the other directions. We have just seen that 5 years ago when the peg between the Swiss and the euros actually just fell apart. And then everybody said, okay, the Swiss economy goes into a recession. It didn't happen. I think what is really crucial is also to look which part of the market is working right now. Definitely the gold market worked. I think what you also should have right now is, you might be surprised, just cash, even if in a negative interest rate environment, because what you need right now as an investor, you have to need flexibility. So when you get more clarity, when the dust actually settles, then you can go into one or the other direction.
Is that what clients are wanting? More liquidity?
I think short term, it definitely makes sense. We just took some chips off the table, not in equities, but in gold, and increased our cash quota further. We already increased the cash quota 1 month ago by going back to neutral in equities, simply because I think for 2 to 3 months, you can clearly tell your client, your investor, we went to the sidelines, we looked at the situation, and we go back into the market with the money.
Thomas Wille, thank you very much indeed. Well, you can get involved in all of today's news by checking out our social media pages. We are on Instagram, Twitter, Facebook and LinkedIn. Whatever the comment, it's always great to hear from you. And of course, everything is, as always, available on our website. The address there, cnnmoney.ch. We'll see you tomorrow. Bye-bye.